Today, we're opening up the case file on Bajaj Housing Finance. We're going to look at this whole thing from the perspective of a cautious investor. Someone who wants to sift through the hype, the headlines, and the hard numbers to figure out what's really going on here. So get this. You have a company with one of the biggest names in the business, Bajaj, right? Finance, FinServ, auto, the whole crew. It has this blockbuster IPO, the stock soars, and then it crashes. It falls a staggering 60%, landing right back where it started. So the big question is this a golden second chance to get in on a great company, or is this a massive red flag screaming at us to stay away? That's the puzzle we're going to solve today. To really get what's happening now, we have to jump in a time machine. We need to go all the way back to the IPO and break down that initial valuation. Because honestly, that's where the first clues to this whole mystery are hiding. Okay, so at its IPO, Bajaj Housing Finance was priced at a price-to-earnings ratio of 35 times. Now, to put that into perspective, most other companies in their industry were trading somewhere between 11 and 15 times. So right out of the gate, this thing was priced at a huge, huge premium. But here's a really important tip for anyone looking at a financial company. Earnings, they can jump all over the place. What you really want to look at is the book value. It's a much more stable, reliable number that tells you what the company is fundamentally worth. For a lender, their balance sheet is their business, so this is the metric that truly counts. And when we look at that price-to-book ratio, the story gets even clearer. At the IPO, the company was priced at 4 times its book value. 4 times. The industry average at the time? Just about 1.6. That means it was valued at 2.5 times its competitors, mostly just because of that powerful Bajaj brand name. And then the hype train left the station. After listing, the market got so excited that it pushed that ratio all the way up to an insane 6.5 times book value. Look, no matter how amazing a company is, a valuation like that is just not sustainable. So that 60% drop we saw, it wasn't really a sign of a broken business. It was pretty much an inevitable and necessary correction from a price that was just way too high to begin with. All right, so that's the past. Let's fast forward to today. The situation on the ground is totally different now. So let's dig into the current evidence. We're talking about the real challenges the company is up against versus its own powerful, built-in strengths. And this right here is a huge deal. The company's own management has come out and said they're lowering their growth expectations. They've gone from forecasting a blistering 42% growth rate down to a much more sober 20 to 22%. And they've given us some very clear reasons why. Right now, the company is basically sailing into a perfect storm of headwinds. There are 3 big ones. First, competition from the big banks is just getting more and more intense. Second, those high interest rates aren't going away, and that makes borrowing money expensive. And third, there's this constant cloud of regulatory risk hanging over the whole sector. Now, to really get that competition angle, you have to understand something called CASA deposits. Think about it. This is the super cheap money that banks get from all of our regular current and savings accounts. It's this giant pool of low-cost funds that is a privilege just for banks. NBFCs like Bajaj Housing Finance, they don't get access to it. And this just lays out the disadvantage perfectly. On one side, you have the banks funding their loans with those cheap, stable CASA deposits. But on the other side, you have the NBFCs. They have to go out and borrow money from the open market, which is way more expensive and volatile. So when interest rates go up, it squeezes the profit margins for NBFCs a lot more than it does for their banking rivals. And then you have the regulators. And believe me, this risk is not just theoretical. Ever since a major NBFC collapsed back in 2018, the regulators have been tightening the screws on the whole industry. They're making the rules for NBFCs look more and more like the super strict rules for banks. This forces them to keep more cash on the sidelines, which can directly hit their profits. Okay, but that is only half the story, because despite all those challenges, and they are very real, this company has some seriously powerful strengths that make for a really strong counter-argument. See, it all comes down to their business model. Just look at their loan book. The vast majority of it, we're talking nearly 90%, is made up of extremely safe, low-risk loans. You've got home loans, loans against property, and lease rental discounting, which is basically a loan secured by future rent from a commercial property. These are super secure, which means they have one of the best, cleanest loan books in the entire industry, with very few defaults. But, and this is a big but, that safety comes with a trade-off. It's a classic dilemma. On one hand, you get fantastic loan quality and almost no bad loans. But on the other hand, safer loans mean lower interest income. And that translates directly to a lower return on equity, about 12% for them, while some of their riskier competitors are pulling in 16 to 18%. And of course, you absolutely cannot talk about this company without talking about the Bajaj ecosystem. This might be their biggest weapon. They can just tap into the massive existing customer base of Bajaj Finance and FinServe and offer them home loans. This means their cost to get a new customer is practically nothing compared to their rivals. It's an incredible advantage that almost no one else can match. All right, we've looked at the IPO hype, the big correction, the headwinds blowing against them, and their core strengths. Now it's time to put it all together on the scales, weigh the evidence, and come to a verdict on this investment case. So here it is, the investor's balance sheet, laid out nice and simple. In the positives column, you've got that rock-solid low-risk loan book and the powerful synergy from the Bajaj Group. But in the risks column, you have that lower profitability, the fierce competition from banks, and that constant pressure from regulators. So where does that leave us on the valuation today? Well, the stock is trading at about 3 times its book value. Now, that is way better than the 4 times at the IPO, for sure. But here's the catch. You usually pay a premium price for a company that has premium profitability. And like we saw, their return on equity is actually lower than their peers. So when you put all the pieces of evidence together, the conclusion we come to is that this stock isn't a screaming pound-the-table bargain. But it's not wildly overpriced either. It seems to be hovering right in that gray zone, somewhere between slightly undervalued and fairly valued. So, in the end, the decision here isn't just about this one company. It's about a much bigger question you have to ask yourself. How confident are you in the future of the entire Indian housing market? And do you believe a non-banking company, even one with the power of Bajaj behind it, can truly win against the big banking giants in the long run? That's the real call you as an investor.